Let's cross over to Nigeria now. Adesoji Solanke, banking analyst from Renaissance Group, is standing by to run us through the results and comments from Diamond Bank's CFO regarding perhaps M&A activity in the sector. Adesoji, let's get your views firstly on those results, looking at a pre-tax profit for the first quarter of 7.5 billion naira, and that of course after we saw 1.5 billion naira booked in the fourth quarter of 2011. It ran past any analyst's forecast. Why did it beat forecast by such a large margin?
Morning. Diamond Bank's first quarter results, the key driver in there was asset margins. And what you're seeing is a strong recovery in asset margins driven by, first of all, the AMCON bonds they received in exchange for NPL sold late last year. The second thing driving that is we are finally seeing the full run-through of higher interest rates that happened in Q4 last year. So the landing impact happened in the first quarter of the year. And Diamond Bank is also showing strong underlying loan growth. So year to date, you're seeing the loan book having expanded by about 11% year to date. So those three things are the key drivers of the profitability performance. Non-interest revenue still growing quite strongly. And going back to the NIMs, it's actually back to about 10.2% from about 9.4% in FY11. So really, the improvement in these numbers is driven by the strong improvement at, for funded income transactions.
I was speaking to the CFO yesterday, and of course they're keeping mum on which banks they're likely to look at having a tie-up in the banking sector with. Can we speculate around that right now? We know that they were looking at something last year that fell through. Are there any banks that are likely to be a good candidate for match-up with Diamond Bank?
Well, like you rightly said, anything I say is really speculation. The only clear banks out there are the bridge banks, the ones owned by AMCON, 100%. So those are the only ones which are obviously out there in the fore. And I think just to go back to Diamond Bank, we think Diamond Bank to an extent needs scale, and that's really to justify the high fixed cost base they're running on. What you find out is relative to all the tier 2 banks, Diamond Bank's cost average assets is significantly higher than everyone else. So they need to do either of two things. Either they look inwards at their cost base to try and justify where that probably overlaps, and they need to roll that down, or they need to look inwards, or should I say they also need to justify, should I say increase their scale to justify the cost base they're running on. So we think Diamond Bank justifiably possibly needs scale. But in terms of what bank to potentially look at, the only ones that are potentially glaring are the bridge banks.
Does it definitely need to have that tie-up with another bank in order to effectively hold on to the market share that it has right now? Can it do that by perhaps raising funds in the market? We know it's looking to come to the market and raise $200 billion in terms of tier 2 capital. So could it not come to the market, raise funds and leverage that in order to grow its presence?
I think we need to get the facts sort of properly. The tier 2 capital raise, they need that to increase their capital adequacy ratio. It's that simple. Their CR is about 12%, so they certainly need some sort of capital, and Diamond Bank can get to tier 2 at this point in time. So that is why they're raising the tier 2 capital. They need to get that CR up so they can justify even any sort of organic growth in the next medium term. In terms of organic growth over time, the challenge the tier 2 banks face is a few banks have gotten so much bigger, and the smaller banks have been left with so much smaller market share. We think the tier 1 banks going forward control anything about 70% of the market. So then you have about 7 tier 1 banks. Then you're left with about 13 banks fighting for 30% market share. So there's you're going to push so hard to gain potential traction over time. That is the challenge any of the smaller banks face. So it's either you become a very niche, successful tier 2 bank and sell your story successfully to the market, or you gain some scale. We think you can't afford to just play in that middle space. We think you will certainly be pushed downwards going forward.